Hello, I'm joined by Simon Gergel, who manages Merchants Trust. Simon, welcome.
Good morning.
Could you just begin by giving us a general overview of the objective of the trust?
Yeah, the objective of Merchants Trust is to deliver a high and rising income stream and a good total return over the medium to long term by investing in UK equities.
Right. And I understand that some of your holdings may have been affected quite a lot by the recent changes in the oil price. Can you give us an idea of how that's played out for you?
Yes, so it's quite a complex situation, the oil price. I mean, probably a number of things to consider. Firstly, the oil price itself is affected by both supply and demand. They're both elastic. They respond to the price coming down. So we do expect over time that you'll see production cuts that you're seeing, and you'll see demand for oil increase, which should normalise the price, so the price we would expect to recover over time. Within the portfolio, the main exposure to oil is in the big integrated companies, BP and Shell, and they are diversified businesses, and they're able to cut costs quite aggressively in response to falling oil price to preserve their cash flows and to be able to sustain their dividends. So we think unless you take a particularly severe and prolonged downturn in the oil price, we think their dividend flows will be safe, and ultimately the shares look quite interesting here. We also have a company called Amec Foster Wheeler, which is an oil services and engineering services company. That's definitely more exposed to the oil price collapse. But the synergies from putting Amec and Foster Wheeler together, I think, drive a lot of cost savings, should drive profits forward. And again, at the current level, that looks an interesting investment. And I suppose the final thing to say is, in the broader perspective, a lower oil price is actually quite good for the economy. It's good for consumer spending. It actually reduces costs for a number of businesses. And within our portfolio, we have quite a lot of exposure to the travel and leisure sector, to the consumer generally. And many of those companies will benefit from a falling oil price. So it's certainly not all negative.
Yeah, quite a mitigation of what might otherwise be a bad picture. And what effect do you think various outcomes of this year's general election might have, or maybe are having, in terms of uncertainty at the moment?
Yeah, it's not obvious you can see it at the moment in terms of the market move, but we do expect volatility as we go up towards the election. Ironically, perhaps the result which will have the least effect medium to long term on the market would be no strong view either way. So if you get a strong win, if the Conservatives get a majority or a very strong coalition, they'd almost certainly have to bring in a referendum on Europe, which I think would be very uncertain for the markets. Equally, if Labour were to get in with a majority or a very strong coalition, you could see some of the more radical propositions on the left side of on the socialist agenda get put into place, and I think the market again might take some fright from that. But if you end up with a weak government, or maybe a minority government or a coalition, ironically, although the market have a lot of uncertainty about what's going to happen, the room for manoeuvre of the politicians is quite limited. So you might end up with not a great deal of change from where we are today in terms of economic policy, which the market could ultimately see as quite a good outcome.
Yeah, strangely stability coming from a degree of uncertainty.
Yeah, it's unusual.
Quite a few of your holdings are listed in America and pay their dividends in dollars. Has there been much effect of the strong dollar over the last 6 months?
Yeah, about a third of the business companies, just under 30%, are actually quoted in dollars and pay dividends in dollars, and about 1% in euros, so you can ignore the euro effect. And actually the underlying exposure of the portfolio to dollar in particular is even higher than that, because many companies that pay dividends in sterling actually have significant operations in America or other dollar areas. So the dollar moves are very significant. They have been a bit of a headwind, to be honest, until recently. But clearly the recent strength of the dollar is helpful, both in terms of companies bringing profits back into the UK, but also if they're paying dollar dividends, you'll see better dividend growth from those cash flows when you translate them back to sterling than you had been. So we would expect dividend growth to pick up a bit from those dollar earners as we go through this year.
And has the portfolio changed very much recently?
It's not been a significant change, but the biggest feature in the market in the last 6 months has been the very strong performance of companies that are seen as safe, defensive, or companies that are seen as having a very safe dividend yield. And particularly as interest rates have come down, investors have been looking for another home for their money. So those companies have performed very well and share prices have gone up. We've been taking profits on many of those defensive companies where the valuations have reached levels that either we think are full or even expensive. And we've been reinvesting in areas where we find opportunities. So, for example, UK construction, we've bought a company called Kier Group, which is a diversified construction and services company. We've put more money into CRH, which is a building material company. So we're finding opportunities outside of the more defensive areas where there is some good value.
And is there anything else that investors should look out for from merchants over the next 6 months?
One of the big themes we're thinking about is what happens when interest rates go up, particularly in America. And we're probably getting closer to that point. It may well be in the summer this year we see the first interest rate rise. So within the portfolio, there are a number of companies that would benefit from higher interest rates, particularly dollar rates. So HSBC is a good example. They clearly have a lot of money, customers' money on deposit, which they're paying very little interest. And as interest rates go up, they can keep a bigger slice of the pie. But also companies like ICAP, which is an interdealer broker, would benefit from companies having to hedge their exchange rate, their interest rate risk, which they've not really had to do when interest rates have been so low. So activity for interdealer brokers would pick up as well. So where we can, we're trying to find businesses that benefit from rates going up at some point.
Very interesting. Simon, thank you very much indeed. And if you'd like any more information, please look at the Edison website.